All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account's 6% or higher yield remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built-in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA-registered, SIPC-insured U.S.-based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted and get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description. Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm going to wish you a happy new year, particularly to the people that are on this show, but also those of you that are listening. Even though when you hear this, we will have done our first Friday live stream for January. So this is technically the second episode that released, but it's the first episode. We're recording this on January 2nd. Of course, I'm Jason Hall, joined as usual by my good friend, who we are dubbing for this episode the other Jeff Santoro. How you doing, other Jeff?
I'm happy to be other Jeff. We've had other Jasons on before, and Now we finally have another Jeff on the show. So this is already the best episode we've ever done. I can just tell you right now.
I don't know. The Jeff that's joining you, unless I'm wrong, the probabilities are he doesn't have the same birthday as you, which the Jason that we had on did have the same birthday as me. So
that's true. We've yet to find a Jeff with the same birthday as me, I think. Well, we can find that out later.
Either way, our guest this week, we're going to introduce him in a little bit. Our guest this week is certainly an upgrade over the baseline of shows that are Jeff and other Jason. That's for sure. All right, we got some little bit of housekeeping we want to do before we get going, Jeff.
Yeah, real quick. It is a new year, and what better way to start the year than to give us a 5-star rating and a review on the podcast apps? That's the best way for people to find the show. You can check out our newsletter.
Keeps on giving to us.
That's right.
Yeah,
that's right. You can check out our newsletter at investingunscripted.com. And I'll leave it there for now so we can dive into the conversation.
Two more things to add. Just a reminder, those that have been following the newsletter, we're no longer doing the transcripts. Most of the podcast platforms have transcripts now, so it's a lot less work for me. So those few of you that said you used it, apologies. My life being better is a little more important right now. I apologize. Second thing I want to say, those of you that are following the portfolio contests, we're not going to really talk about it on this show, but if you haven't listened to the first Friday live stream in your podcast feed, go ahead and listen to that. We're going to talk about the new contest and kind of what we've built, the frameworks for that on that episode. So go ahead and check that one out. Without further ado, Jeff Fischer. Hey, Jeff.
Hey, Jason. Hey, Jeff.
Hey.
Good. Happy 2025.
Yeah, it's fantastic to be starting off 2025 with you on the show. For those that don't know, I'm going to give a little bit of an introduction, and then we'll get going with your origin story and the things I don't know about you, which are far more than the few things that I do. So, Jeff, you and I crossed paths at the Motley Fool a tiny bit over the years. We never really knew each other, but I know you very well by reputation. And your results as an investor, the thing that I know the most about you was you ran the Motley Fool Pro service for a long time, which was one of the best products I think that the Motley Fool had for a long time. It was really, I don't want to say a hedge fund strategy because it wasn't like private investments and all the other things that hedge funds might be able to do, selling trading volume and all that kind of things. But it's in terms of like using the whole book of things that an individual investor might be able to use, investing in the retail publicly traded bucket of stuff. You used a lot of those different things. It was really successful. Moved on from that at the Motley Fool. The Motley Fool launched a hedge fund, which you ran for a number of years. You've recently moved on to your own ventures, and I'm going to leave it from there. You can fill in the blanks. Let's talk a little bit about, after you kind of fill in those blanks, let's talk about the origin story. You know, how did you become the superhero investor, Jeff Fischer?
I have no idea. Is that really true? Is that
radioactive spiders in your path?
Well, that sounds more accurate. Yes.
There we go.
Thank you, Jason. That's very kind. I began investing, like many of us, at a very young age. I was a teenager when I was drawn to the stock market. And then I'm old enough that I was young when the Motley Fool started about 30 years ago. So I stumbled upon them online in 1994, which don't do the math there, and became a Motley Fool employee by 1996, moved from Chicago out to Alexandria, Virginia, and now I'm in DC. So I've stayed out here this whole time. But yeah, the Motley Fool is really where I learned best how to invest, to be a long-term investor and to own strong growing companies over the years. And I was fortunate to run several services there. And then you mentioned Pro, Jason, Motley Fool Pro. At the 10-year anniversary, we closed it to launch a private hedge fund, which was also an exceptional experience. And hopefully we served our shareholders well. I think we did. So yeah, it's been investing my whole life, always working towards financial freedom, for lack of a better word.
I'm going to foreshadow a little bit here. Towards the end of the show, we'll talk a little bit about your why and some of the things outside of, like the things in the wild that you're doing in the real world that drive you. Is that why I think is really, really important. We're going to talk a lot about options today, but one of the things that's challenging, and we'll talk about this for investors out there that are looking at ways to supercharge their investing by signing up for a newsletter like at the Motley Fool or 7 Investing or one of those sorts of products. One of the things that can be really challenging, maybe you can talk about, particularly with something like Motley Fool Pro, is the importance of being able to navigate markets and move reasonably quickly. We're never going to be faster than the quants. We're never going to be faster than the high-speed traders, but still there is a little bit of velocity that can be to your advantage. So what were some of the reasons closing Motley Fool Pro and going to a hedge fund strategy where the differences between, hey, individual investor out there, we're going to send you an email and here's the things that we're going to do, but we're going to email you and tell you to do them first, versus make a commitment with your capital to us and we're just going to do all of the things when we decide it's time to do them. What's the difference there?
Yeah, logistically, it was a question of numbers. Motley Fool Pro had thousands of subscribers, Jason, and we would pre-announce to them, as the Motley Fool does with its subscribers, pre-announce what we plan to do with the real money portfolio we were managing in front of them. So we were managing $1 million. We grew it to about $5.5 million, pre-announcing every trade. So you would send your intention out to thousands of subscribers, and then they would act on it. And that would very frequently move the price for everybody. And then we would make the trade within 1 to 30 days. So we would wait and place the trade ourselves. But we were using options, we were shorting. And in that universe, it's tricky. You don't want the price to move too much, of course, ever. And so at the 10-year mark, it really was a good inflection point at which to close the service. We felt like we had shared the strategy with everyone for enough years that many people told us they were comfortable with it. They were doing it on their own as well. It was time to move to the next thing. And a private fund, we, of course, with pooled capital could, like any hedge fund, just invest privately and more quickly. That said, I wouldn't say speed is necessary. Of all my investing, the best outcomes are the slowest things. The things I've owned the longest have been the most rewarding. But still, it was a logistical concern that you touched on.
Yeah, that's a really good clarification. And I think part of the nuance is, particularly if you're doing things like shorting or with options, which the prices can be relatively volatile. And even more so, it's amplified if the smaller the market cap or the lower the volume is for a company. If you tell thousands and thousands of investors that are paying for an expensive service, which means that they're probably managing sizable portfolios, what you're going to do, it's going to potentially change the dynamic significantly before you can actually do it. So you bring all that behind the curtain and you just do it, and you're not telling the market what's going to happen and potentially moving the market enough that it doesn't work as well as what you had planned for yourself.
Exactly right. And I will say, I don't believe it was any easier once we moved. Logistically, it was the trading in and out, but with much larger sums, we would typically take days to place a trade or unwind a trade. So it was a new learning curve, and that you had to learn very quickly. and just to move gradually into almost any position except for maybe the very largest companies.
So you mentioned 10 years was a good inflection point, a good time to close that down. Part of the reason being that a lot of the members that are subscribers to that service had kind of figured out the strategies for their own and felt comfortable. And I think that's a good way to pivot into talking about options, because as someone who is just recently myself become comfortable flying solo on some very basic option strategies, it took me a long time to just feel comfortable, to wrap my head around how they work. I don't want to say it's difficult, because it's once you do understand it, it's actually fairly simple. But the terminology, the lingo, the fact that everything has like a flip side of the coin, that's like the opposite end of the, I mean, I know that's how all trades work, but with the difference between calls and puts and selling and buying, like it's very much two sides of the same coin. So to the best that you can, I'd like you to maybe give us a very beginner's guide to what options are, how they work, and then we can get into some more specifics after we maybe hit the 101 level of knowledge.
Great, Jeff. And of course, jump in anytime that I seem less than clear or you have a question or comment.
Sure.
So let's set this.
We will have lots of both.
We'll see. We'll see. It's a new year. We're all really fresh, Let's set the stage a little for people, especially those who are new to options. First off, I think we all agree the first thing is to build your equity, your stock portfolio. I started using options in 2000, so I had been investing for more than 10 years already. And I believe it's best that you have at least a six-figure portfolio before you consider options. Options are a complement to your stocks. I believe, or my experience is, you'll make most of your wealth over the years owning great companies. And then options are an excellent complement on the side of that. So if you're 80% equities, options might represent 10-ish% of your exposure. And then maybe you have 10% cash, which is kind of how I play it frequently. Options solve the cash flow problem that stock investing presents to most of us. And by that, I mean, I started investing like many of us with thoughts of, financial security and financial freedom. But you realize pretty early on that without cash flow, that's hard to achieve. You can have millions of dollars in stock, but unless it's giving you cash, your only way to access it is to sell, which is the last thing you want to do, even partially. So I was looking for a solution, and that's where options came along as, in my experience, a great cash flow generating complement to your stocks. So you can use them to target appreciation, either upside or downside, or you can sell to open them to target cash flow or income into your portfolio that you can then use as you wish. So let's step back a little bit from that opening and explain what an option is very briefly. An option gives the owner the right to buy or sell the stock it represents at a set price, which is called the strike price, by a set date, which is the expiration date. A typical U.S. option, each contract represents 100 shares of the stock. And that's where the leverage comes in, because an option will typically trade at a fraction of the price of the stock. You might have a $100 stock, but you could look at options for it that trade for $2 or $3 only. And that contract represents 100 shares. So there's a lot of inherent leverage in options. Now, options trade on the market, very liquid and transparent, just like a stock. You can buy and sell them anytime you want. You could do it all day if you wanted to, certainly not advised, but they always have a bid and ask. And so they're very liquid. Some people may remember Warren Buffett saying derivatives are weapons of mass destruction. He was speaking of unlisted, non-transparent, esoteric, like arcane sort of derivatives that Wall Street can make up on the sidelines somewhere privately.
And will make up. As soon as somebody calls and expresses an interest in a certain thing, they will create something that does that thing for a fee.
Very true. And then it may or may not work out very well, or it may make the headlines as it blows up. But Warren Buffett has used stock options. So he wasn't speaking of those. He's sold to open put options to buy more shares of Coca-Cola at lower prices and to orchestrate his buyout of Burlington Northern as a whole. So it's pretty fascinating to see him use options. He's also written put options on the S&P 500, which I've done as well, to good effect. And you could imagine why. The S&P on average rises over time. You can look at an option that expires in 2 or 3 years and write a put option on the S&P, get paid quite well because there's a lot of demand, and just repeat that every few years as an income trade. So anyway, so an option represents a stock and the right to buy or sell that stock at a set price, the strike price that you choose, by an expiration date that you also choose. So you can look across the board. Options expire from daily to weekly to monthly to 2 to 3 years out, and choose the strategy you want. And that's where it really gets fascinating and useful for strategic investors like us. It isn't, you're not gambling. You're not taking a dumb risk. You're choosing a price / valuation on a stock that you want to target. And then you're choosing what you want to be paid or what you want to pay for that option to make that trade. And then you place it and you see how it plays out over time, but always with a long-term strategy in mind. Even when I use weekly options, I have a long-term strategy to keep the position going indefinitely, because again, the goal is, in this case, steady cash flow or income. I'll stop there and see if that's clear at all or what you guys want to say.
Hey, everybody, we'll be right back. But first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellow Brick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. I think it's clear. The place I wanted to pause is something you said early on, which I think is a point worth going back to, which is options used correctly, at least in your opinion, and I think Jason and I as well, are a complement to your wealth building strategy. And I think the reason I want to pause there is when you just pay attention to what's out there in terms of social media and some of the less reputable people trying to make money by getting you to trade certain things, it is presented in a way that's not a complement to building wealth. It is presented as the way to build wealth, full stop. And I think what scared me when I was newer was just kind of knowing tangentially some of the ways people have blown up their life savings with options because they don't know what they're doing or they're being too risky. So I think just stopping on that point, that this is something to do on this, like in addition to owning companies for the long term, something to do when you have a sizable portfolio already, which means you're probably not brand new at investing unless you just inherited a large portfolio. So I think maybe we could pause a little bit more on, or maybe you're going to go into this next, but one of the things I think is important to talk about is like how to trade options safely, in a way that's not going to take on, everything's risky, but a way that's not going to take on enough risk to blow up your portfolio. And maybe how to think about this if you're listening and going, that sounds amazing. It's too good to be true. How do you caution new investors who want to try options, but also maybe guide them to do it the right way?
Yeah, Jeff. So of course, I know my experience best. And that said, I know other people use options differently. And there are communities that you're referring to and strategies where people risk basically their portfolio is options, and they're rolling the dice every day to try to make a lot of money quickly. And though that may succeed for a while, it ultimately most likely blows up or doesn't last. And that's why I think it's really important to impress upon people the idea of building a really solid foundation first, which in my belief should be equities, on which then you use options as well. I know of one investor who trades options who has done well over the last many, many years, long enough where they have a strategy that works and they're extremely disciplined. And even they are not looking to make large amounts. When they make 40, 50% on an option, which can happen in 20 minutes, they typically take the gain and move on. Maybe that's for another podcast that we talk about that sort of thing, because that's like play time. That's once you've already made it, once you're all set, once you have money that you can, if you want to do that, that sort of thing. But equities first, and then options as a complement. How is it done safely? How is it done conservatively, let's say? I think there are two ways to start. The first is, as we said, you can buy to open an option where you put the money in, or you can sell to open an option where you collect the premium, the payment to yourself.
Let's actually break that down to Jeff. I'm going to kind of spit out my kind of thinking about almost kind of the four main options trades, and then you can tell everybody how I'm wrong. There's a lot of verbiage across them, but you have calls and puts, you have buying and selling, right? So a call is, if you're selling the call, you're giving somebody else the right. They're giving you money. That's the premium you're getting by selling the call to them, but you're giving somebody else the right to take your shares at a set price at some future date. If you're buying the call, you're giving somebody else the money to buy the right to call those shares away from them to yourself. How am I doing so far?
Good. Let's see if I can complement what you just said and say it a little differently, perhaps. A call gives you the right to buy or sell a stock.
Yep.
So if you own the call, you have the right to buy the stock. If you sell to open the call to start, you're giving away the right to someone to buy the stock from you. And that's called a covered call, which probably many people have heard of.
And that's the typical kind of starting point for most people on their options journey. But this is where the verbiage can get really confusing, because if somebody's short a call, it doesn't mean that they're short the stock, right? It means they're short the call. It means they've sold the call. If you sell covered calls, you want the price to kind of stay around or maybe below where you sold the call price for, because that's where you make money, because you just get the premium and you keep your shares. They don't get called away from you. If you've bought the call, you want the price to go up, because then you can, so let's say you buy calls on a stock at $100 and the stock goes up to 110. Now that's $10 a share in profit that you can realize on that call, right? The inverse of that's if you sold $100 calls and the stock goes to 90, well, they're not going to pay $100 for $90 stocks. The call is going to expire worthless and you're going to get the premium. But if it goes up to 110 and you sold it for 100, well, you sell it for 100 and somebody else gets that $10 premium. You're on the other side of the trade.
Right. Right. So
that's only half of it. That's just calls. We haven't even talked about puts.
Right. So, and the challenge is always to simplify it. And we didn't mention yet, but I co-founded with Jim Gillies and ran Motley Fool Options for about 9 years as well, almost 10 years as well.
Yeah.
And Motley Fool Options was completely to educate people about options and our favorite strategies. And the strategies we would use most were sell to open put options, and I'll explain that in a second, and sell to open covered calls, as you were just talking about, Jason. But this is maybe a good moment to emphatically say, do not sell to open calls on shares you want to keep owning. Do not. You can lose fortunes that way. People who lost their shares of NVIDIA to covered calls or such. So the strategy I like to start with and think people should consider starting with is selling to open put options. And maybe I can explain this simply. And from this podcast, if anyone gets the notion of one strategy down, that would be a big win. And then maybe we'll talk again in a few months.
Love it.
So selling to open put options is akin to selling an insurance policy. Let's say a stock is trading at $25 per share. You know the company well. You would like to buy shares, but only at $20 or lower. So you can look at the options and sell to open a put option with a $20 strike price that expires, let's say, in 3 months. And for ease of math, let's say you're paid $1 per share for that contract. That $1 going into a $20 strike price is a 5% yield in 3 months. So you're being paid quite well annualized. And the stock is at 25, remember. So in this case, by selling to open a 20 strike price put option, you have obligated yourself to buy shares at 20 or lower if the stock is 20 or lower by your expiration date in 3 months. But the stock is starting at 25, so you're getting quite a cushion and you're being paid while you wait. Now assume the stock stays above 20 or is above 20 at your expiration in 3 months. You just keep that dollar per share you were paid, that 5%, and you move on. You can write another put option. The option expired unused. If the stock does fall below 20 by your expiration date in 3 months, you are put the shares, they're bought in your account. You still keep the $1 you were paid per share. So your net buy price is 19. And then you go on to own the stock as long as you like, same as ever. So it's an income strategy that targets a lower buy price on companies that you presumably know and would be happy to buy or buy more of. Now, in many cases, I sell put options on companies I already own and know them well. And so I'm happy to buy more or get paid income in the meantime. And then if the stock does rise, it's because you're bullish on the stock ultimately. Right. You already own it. So that's one.
I think that's one of the biggest misconceptions about short puts. If you see that like in somebody's disclosure or you're just reading on Twitter and somebody's talking about that kind of thing, it's actually, you're generally pretty bullish on a stock if you're selling puts, because even if the stock price falls below the price you're willing to pay, you believe in that business and you believe it's a fair price. If you have a plan anyway, that would be theoretically you would be willing to pay that price even if it falls below it.
Yeah. Can I just ask a clarifying question then? Because that's a strategy that I've not done myself yet, but I think I understand it. The risk, so to speak, with that strategy is if that stock you're hoping to buy for 20 drops to 15, you're still buying it for 20. Is that correct?
That's correct. Okay. And you still keep the dollar per share. However, so your net buy price will be 19. And this is a little more in the weeds, but there's a way to delay the purchase of the stock. You simply roll the put option to a further month out. You get paid a premium again, a premium that's larger than the current price because options have time value. To throw more lingo out there, the longer until an option expires, the more value ascribed to that option. And it's generally time value, it's called, which is just the price of the uncertainty of what happens between now and expiration. So Jeff, you can roll the option 3 more months out and say you get paid. If the stock is 15, you'll probably get paid about $6, $7 per share for that. So $5 of intrinsic value, which is the difference between the share price and the strike price, and then extra time value on top of that. And then you wait again and see if the stock gets above 20 or not. Now, the funny thing is, in a lot of cases over the history of my own using options now for 24 years, getting the stock has been a great benefit. Like, oh, thank goodness I got this stock. And now years later, I'm so glad I own it. But when you're just targeting income, you can roll the option and not accept shares. And the flip side of another way to make income is the covered call strategy that we talked about. And that's where you already own at least 100 shares of stock, because again, each option represents 100 shares. And then you sell to open one call for every 100 shares you own at a strike price where you theoretically or realistically would be okay letting the shares get called away from you or sold from you. And it's the opposite of the put I just explained. Say you own a stock at 70, you're willing to sell at 75. You could sell to open a 75 strike price call. Say you get paid $1 per share for that. That's your income to keep. If you do lose your stock because it's above 75 at expiration, your net sell price is 76 because you kept that $1. But again, I like to buy 100 share blocks specifically for writing calls, specifically for income. And so when I lose those shares, it's fine. I already own it elsewhere, or it's a company I specifically targeted and don't mind selling. So I don't typically write covered calls on tomorrow's growth stories or dynamic companies that are doing really well. I, of course, want to own those for the long term.
Yeah, that's the one strategy that I've done on my own. So I'm glad I meant to mention earlier the Motley Fool's option service, because that's where I learned a lot of what I do know. And I was following a lot of those recommendations for a while. And where I decided to branch off on my own was doing covered calls, selling covered calls. And the rules I have in my head to make sure that I don't do anything I will regret is I do what you just said. I always buy 100 share blocks, because I don't want to accidentally have shares I've owned for several years get called away. So I buy the shares specifically for the option strategy. I only buy companies I'm happy to own, because what I have learned already is, especially if it's a more volatile stock, I could buy it, it could drop 8% in a week, and now I'm quote unquote stuck with those shares, because it's no longer, I would lose money. And I was doing weekly options. So I got to a position where I can't really write a weekly option anymore, because it's not worth anything. And if they got called away, I would lose money on the whole strategy. So it's like, not shares you're willing to let go and companies you're willing to own have been the two kind of things that have kept me from making any big mistakes, I think. And I think you can do the same thing with longer strategies if you want to wait 3 months, like the typical covered call strategy would be. But I'm glad you talked about puts, because that's maybe my next step, is targeting a stock that I own and like and know really well, and just want to buy it at a better price.
Those are great guidelines, Jeff, and that makes a lot of sense. And to listeners who may be thinking, what is all this lingo? And this seems complicated. And ironically, I crave simplicity, and I do find options to be quite simple, or I did once I experienced them for a little bit. And with Motley Fool Options members and Motley Fool Pro members as well, because we used options there as well, I have yet to meet a member who didn't feel gratitude for learning options. It starts at that level all the way up to the level where this really changed my life. I've met so many members who said, I financed my children's college by writing options. We bought another house thanks to options, which sounds crazy, but it's possible. And so forth, just because it unlocks that key thing that we talked about at the outset, which is cash flow. Like, dividends rarely pay enough cash flow to really make a large difference these days. And options can completely make up for it. But you're right, Jeff, that you need to be very specific and very deliberate with how you use them. And what's the word? Don't overdo it. I typically only have a few options strategies going at any one time. And my first focus these days is income. And so you know your strategy and you just follow it.
Hey, everybody, we'll be right back. But first, a word from our sponsors.
All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA-registered SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted. Get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every single week. From hot stocks such as Nvidia and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
Yeah, and the other thing that I've learned, and you said this earlier, and I agree with you, except I think I have found a way to maybe learn a little bit without the huge portfolio size. Because of the 100 shares you have to buy, I have found that I am fairly limited in what I have the cash to buy right now. Because you don't know my backstory, Jeff. I've been investing for my entire adult life, but only buying individual stocks for the last 5 years. So I can buy 100 shares of something that's maybe trading for $22. Like I can do that. Something that's trading for $300? No. But I understand enough about it now to see the value if you have a large enough portfolio and a large enough chunk of cash to buy 100 shares of bigger stocks. The premiums are higher and all that kind of stuff. But I also have learned I can't have more than one or two covered calls or whatever going at once, or I start to forget, because especially if I'm doing weekly, it's a quick turnaround. It's not set at check in 90 days. So yeah, I can see how a larger portfolio can really supercharge the income you're able to make.
And that's a great point, Jeff, because my experience was very similar. One or two options at a time. We're talking going back to 2000, so it's a very long runway of using options sparingly, but it leads to, by having that knowledge and that experience, it can help you later in life to then know how to generate income on a larger portfolio in a very steady and meaningful way. And that could mean just more flexibility later in your life. So at least in our framework of belief and experience, it's really focused on building a great equity portfolio of companies you love owning that are growing, that are letting you grow wealth over years and even a few decades. And if you are interested in options as a small complement, you learn those as well over the years. And then they're there for you later when it makes more sense to use them more generously for income generation and things of that nature. So yeah, I think it's a very natural progression.
Yeah. So just my experience, individual investor picking stocks for 16 years at this point, and I've followed options and studied for a long time, but only really begun using options in earnest over the past year or so, Jeff. And partly because I've started to transition into that period where I'm moving more of my portfolio into cash, some fixed income investments, and of course with my barbell approach where I do own a lot of dividend stocks, because I am starting to think more and more about like the idea of being able to generate income. But also one thing I'd like to talk about a little bit that you hit on briefly is being able to use options as part of your strategy for building out long-term positions. I'm going to get a little tiny advanced here. I'm bringing in a brand new term, but it's a term that's like a lot of options trades. There's lots of ways to combine different sorts of trades into one strategy. Starting off, just the idea, I love the idea of selling puts. It's something that I begin to use a lot over the past 6 months or so for companies that I know really well, that I know I want to own, that I'm happy to pay this price, even if the stock does fall a little bit below that. Of course, knowing how, having a plan, if it does fall a lot below it, being able to roll it, right, to kind of soak up some of those losses and improve the total outcome. Like, I love that idea, but one of the things that I've done once or twice, and it is the kind of thing that can go spectacularly well, but can also completely blow up. And that's something like a synthetic long. The idea of a synthetic long. So you start with that short put. So you're selling the put, but I'm just going to throw some numbers out there. So let's say,
I love that you're attempting this, Jason. It's like watching the Olympics and this is the triple sow cow coming up on the ice rink.
Right? It is. It's actually more like for me, this is more like doing the triple Lindy from Back to School. If anybody,
I can't wait to
remembers
watch the podcast listens drop as you go into this, Jason. Keep it quick here.
So difficult.
It's gonna be fun.
Big respect to you for tackling this. Right.
You got 30 seconds to explain it, Jason. Go.
Well, I said I can do it in 30 seconds. So again, the idea is to say there's a stock that you're really interested in owning, or you think there's just an opportunity because it's mispriced. The options premiums are pretty good, and you look long term. So let's say this summer you buy a stock that you sell a put. So you're short the put. So somebody could put the stock to you. Let's say it's $10. I'm just going to use that round number, and you can get 50 cents in premium. So that's 5%, right? So you sell that $10 put and you get your 50 cents per share in premium. And so you're short, right? You're short the put, which means if that stock drops, somebody's going to put it to you, but you're bullish, right? So you're like, I'm going to take that premium and I'm going to buy calls with the same price, that $10, what did I say? $10, that has the same expiration. So that's July, right? So here's what happens. The stock goes up. I have those calls that were essentially found money paid for by the puts or partially paid for, however it works out. It can be extremely profitable, even if you're just selling the calls because if the price goes up. The downside is the premium that you earn that could potentially lower your buy price if you want to go long and it's kind of close or whatever, you bought calls that expire worthless if the price drops below that, right? So you have to be willing to follow it and move quickly if the prices get ugly and you try to roll it out. What am I missing that's really important about this that people need to understand?
So a synthetic long, Jason, mirrors the stock price. So it is really an excellent way to have exposure to a stock with generally no capital outlay.
Right.
Because like you said, you sell to open a put, you use the proceeds to buy to open the same call, and suddenly you have a position that will change in value right alongside the stock. Every one contract representing 100 shares. So as with a covered call, you just have to be aware that every put option you sell to open represents 100 shares of stock. So you need that sort of equity buying power in your account. But I like synthetic longs as a way to have stock exposure without having to put out capital to do it. And you can also, you said this summer, Jason, but you could also go out 2.5 years using the longest term options.
Right.
Set up a synthetic long on an Alphabet or some company that you're bullish on over that time period, and then just let it be and let it hopefully appreciate over time. And you didn't put any capital out to set that position up. And these are called combination trades. Generally, they're called spreads, where you conduct at least 2 different options together as one trade. It can be 2, it can be 4, it can be 8 options. It can get crazy, butterflies and all this stuff. And that's another advantage of learning options slowly and steadily over time. After using single trade options for years, maybe you'll move into spreads, or if you want to. But there's so much flexibility. There's so much that you can do with them. So many trades you can set up, so you can be as long-term or as short-term as you like, generally speaking, as conservative or as risk aggressive as you like as well. So there's something for everyone with options if you have the interest. And for me, the interest boiled down to, I want cash flow from my portfolio, period. And so that's mainly what I do. But synthetic longs or just buying long-term call options, let's talk about that for a second. You just buy a single long-term call option on a company that you think has a lot of upside, but that you also think is risky. So instead of paying $30 per share, maybe you'll pay $6 for its call option and just let it go and see what happens in the next 2.5 years. You have, therefore, risked much less capital, but you still have the upside exposure.
I'm glad you mentioned that, because it segues nicely to the next thing I wanted to ask about, which is how to decide what stocks to try any of these strategies on. And the reason I want to ask this is one thing I've noticed you've been doing recently on Twitter, and I think also on Blue Sky, is just straight up saying, like, here are some tickers for stocks that I think are good candidates for this strategy or that strategy. So I'm just curious, like, when you look, you say to yourself, okay, I want to generate income, or whatever else you're trying to do with these strategies. Like, how do you decide to use, just to pick 2 companies we've already talked about, Google or Nvidia or Apple? Like, how do you decide what's the right stock to try the strategy on for the specific strategy?
So I believe in most cases, the valuation really matters to me. I need to be able to put a price on the stock. So the ones I mentioned on Twitter and Blue Sky, Jeff, are free cash flow positive companies. I've mentioned Airbnb as one, where the multiple is reasonable, that it trades at a price to free cash flow in the teens, even in this sort of a slightly heated market, at least. So I want to know that I'm getting a decent price, and that gives you the comfort, peace of mind when the market does inevitably get rocky and the stock is falling on you. You're still assured, well, my price was good to begin with, and now it's getting even better. I'll keep this strategy going because I like the business, I like the price. If I'm in a very high multiple stock, it's harder to have that comfort level when things start going south. If you're using options on a stock that's at 100 times free cash flow and it's only growing 30% a year, and there are many of those out there right now, you could be waiting at least a few years for it to grow into its valuation when the bull market ends. So especially now, I target, for the income trades, companies that are at a reasonable prices to free cash flow. Now, if there are companies that are lacking free cash flow as of yet, but that you strongly believe in, that's where you might just buy long-term call options on it and risk less capital and hope that it does become a great winner, and those call options will appreciate significantly for you. So it's another way to lower your risk as well, using options, in that case, bullishly.
I like that way of thinking about it. It's almost, I don't want to misrepresent it, but it almost is like the opposite of the way at least I think about regular equity investing, right? Like if I buy a company, especially one that I know is overvalued or on the edge of it, but I know I'm going to hold it for 20 years and it's a smaller company and it's fast growing, you can say to yourself, I'm willing to take the chance that this company will grow into its valuation, like you said, but it might take a decade. You don't want to think that way with an option strategy because the strategy will run out before that decade has passed, right? So it's almost like you have to be, like you said, like thinking about price a little bit more, be a little more careful about valuation. That's a good distinction, I think.
Thank you, Jeff. And so we're the three J's, and last week John Rotanti was on the show. So it's only J names allowed.
That's it. No, we started that in December, and so if you're listening and your name starts with J, reach out.
Call in.
There's a good chance I'll have you on the show.
We've definitely have had a lot of J bias on this show. There's no doubt about that.
I was just going to say I have a lot of A tickers in my portfolio. I don't know. I can't get past the A's as I go through stock.
Hey, if it's working for you, you don't need the rest of the alphabet. That's okay. That's okay.
But no, yeah. So valuation, it matters with options as well. And then long term. So the S&P, of course, is everyone's barometer. A lot of funds use it for defense. So put options on the S&P are almost always in demand and always have a good price on them. So if you're long-term bullish the market, I'll just throw out there, I started this in 2021. I couldn't do much trading managing the fund. So I was managing the fund and I had money in the fund. So what I could do on the side were very long-term options. I would just sell to open SPX options on the S&P 500 that would expire in a few years and just let them be. They pay very well. The taxes are beneficial because about half of the position is taxed as long-term, half is short-term, whereas most options are all short-term when you're selling to open them. And of course, the premiums are pretty good, as I just said, but it's the S&P 500. So selling SPX options that expire in the future is maybe one way people can consider starting if they're looking to see how the mechanics of how these income trades work.
So selling the puts.
Selling the puts. Yep.
Right. A couple things just as I'm kind of thinking through our conversation. So one of the things that I think is really important when it comes to options, and this is no different than other investing, but because of the fact that you do have potential binary outcomes and the use of leverage or reserving cash in your portfolio that you become obligated to having to deploy, even if things go poorly, it's really important to have a plan, which you've talked about a lot, and also to understand the implications of things. So for example, if you're buying calls, if the stock price doesn't go up, you lose 100% of your money generally. I mean, you might be able to sell and salvage some pennies, but generally if that strategy doesn't work out, you're probably going to lose 100% of your premium. The upside, like you said, is instead of risking $30 in a stock that falls to 20, if you buy a $6 call, you lose $6 a share instead of $10 a share, right? So it's a way to reduce losses, but it can be more about binary outcome. And then when you're obligating yourself to buy shares, the risk is having to buy shares for significantly less than the market value, or rolling it out and potentially tying up some capital that's reserved for it, or some margin money, depending on your brokerage and that sort of thing. So I'm just curious as to your thoughts about kind of that aspect. How have you kind of bolstered your own brain and your mentality too? Because, it's guts are more important than brains when it comes to managing volatility. So how have you built up your ability to navigate those sorts of things?
So another way to think of it is anytime you're buying to open an option, whether it's a call or a put, you want, and in most cases need, the underlying stock to move a significant amount by your expiration in order for you to make money. Right. Because you're paying the premium upfront, which is typically a pretty decent size. Maybe it's 3%, 4%, 5%. The stock needs to move at least that much within a few months for you to start to become profitable on that trade. Whereas when you're selling to open an option, you're generally thinking the stock will not move dramatically Or if it does in the direction opposite your trade, that's fine. You're getting the premium up front and you get to keep it. But to simplify it a little bit, buying options, you need the stock to move significantly. Selling options,
Volatility is what drives the premium.
exactly. So how to manage that? For me, it's very company specific. It all comes back to, and I hope this simplifies it for people, your belief in the company and its valuation and what you believe its stock can do. So beyond that, I really don't think of options as a different risk animal than a stock itself. I analyze the stock the best I can and its valuation and what I think it will do. And then I look at the option as a sort of overlay of that. And how much do I think the option can move or not move in relation to the stock and its price, if that makes sense.
It makes it sound like it's the same level of mindset that you would need to have to navigate a regular market downturn in a stock that you believe in for the long term. If you think of it as a stock first trade and a options thing second versus the other way around, it sounds like you're saying then it's just like riding out any downturn in a stock you have conviction in.
Yeah, Jeff, that's true. And so the absolute key is that you don't over leverage yourself, that you don't expose yourself too much. A lot of people, once they start to use options and see it work out for a number of months, they think, this is easy money. I just keep bringing in premium. My cash balance is going up. I'm just going to write more puts. You absolutely must maintain discipline and always remember that every contract is 100 shares, and that's 100 shares of real exposure. And the market can turn fast on you. And if the market falls sharply, all these put options become, quote, in the money, meaning you're exposed to the stock 1-to-1, and you're on the hook to either buy it or have the equity to roll the position to keep it going. No matter what, you need equity value in your account to keep the position going. So yeah, the absolute key to managing volatility with options is to keep it as a small complement to your stocks. Keep your exposure reasonable, and then you don't sweat it. You have your few positions going. You have a plan for if it goes against you, either in the case of written puts, you're just going to take the stock and be happy to own it, or you're going to roll a position. It's no sweat. You have to maintain calm by maintaining your exposure levels. I think that's the absolute key. The only times I got shaken up were early when I was using options, and I did exactly what I just described. I started writing more than I should because it was going so well. And then when it turns on you, it's suddenly going not well at all.
I think that's why I like covered calls versus working on the call side of the thing versus the put, because to me, it's more stressful knowing I might have to have money available 3 months from now than it is just having it now. Like, at least with the covered call, I know, like, okay, I already own these 100 shares. The worst that could happen is someone's going to take them from me, or the stock's going to drop and I'm going to just have them and they'll be underwater. But like, it's upfront commitment, I guess is the way I think about it. Whereas,
Jeff,
like,
I have so much money that I don't have to worry about that.
Well, not all of us are as wealthy as you, Jason.
I'm not as wealthy as me, if I'm being honest.
But that's what stresses me out about the put side of it, is because if I understand it correctly, like, I have to, let's say the stock is $100. I have to have that money in my account ready to buy those shares if they're put to me, right? And I know there's limits to what you can, like your brokerage won't let you, to some point, they won't let you spend more than you can cover. And if you use margin, they'll just start selling your shares to cover it. But you don't want that to happen. Like, you want to, I think that's the piece that stresses me out. That's why I liked starting with covered calls, but I do need to branch out at some point. So,
and many people do, Jeff. And I know friends of my parents who retired, and this is a good case study because they've been retired a long time, 20 years ago or so, and they use covered calls exclusively to generate extra income. And it's helped them greatly to have a more flexible retirement. So a lot of people start with covered calls because you already own the stock. There's no extra potential obligation. When it comes to writing puts, you do want to have the cash aside. And this brings up the point that everything is a trade-off.
Yeah.
For whatever reason, I generally have kept 10% to even 20% cash. It's just kind of how I've operated. I'm more comfortable that way. And so for me, using options was a natural addition because I had cash anyway on the side, and it was a way to generate a yield on that cash. That said, if I had just invested all that cash, maybe at this point it would be worth more overall, It's a trade-off though that I'm comfortable and happy with, because to me, the cash flow generation, learning how to earn that sustainably and keep it going was more important than being 100% invested all the time.
Mm-hmm.
And in addition, I just felt more comfortable with the cash. I learned early on in investing, when I was 100% invested, when things got really rocky, I wasn't 100% comfortable.
Yeah.
And I'd look to things to sell to raise some cash. And so it was a sub up, not
at the worst time to be looking for things to sell.
Right.
Yes, exactly. You mentioned the cash part. This one thing I did want to talk about, because I think it's one of the catalysts that's led to me deciding to make the move to start using options a little bit more. Because, well, number one, you can make that cash productive, like you talked about, even though it's obligated to something you've gotten the premium, right? But cash is actually kind of productive now in ways that most investors haven't seen it in the better part of the past couple of decades. So you're actually letting the cash generate. Sure, it's only half the market's long-term averages, but getting paid to have that optionality of the cash, and then still using that cash to generate some premiums too, with the risk of being put shares in the future. I think it is something that maybe more investors should think about, that have been considering taking that step, but aren't as comfortable having as much cash in their portfolios, because you could get a little bit of double productivity from the cash.
Exactly, Jason. And now is a great time to think about it. Make sure your broker is paying you money on your cash. Like, I use Interactive Brokers as my main account, and that's paying 4.4%, I think, right now on cash. A lot of brokers really don't pay anything, and that's a significant return you're foregoing. So to have that cash earning that yield, and then options yield on top of it. And then thirdly, when interest rates are higher as they are now, options premiums are higher as well. So you're being paid more for the options that you're selling as well. So personally, I don't mind these higher rates. Well, of course, we want the happy middle ground for everybody. So houses are affordable, and life is affordable, and inflation is reasonable, and so forth. But rates above 0% are not the worst thing either, or in general.
So just as a final options related question, and then we can maybe wrap up by talking about what you're up to now these days that you've moved on from the Fool's Hedge Fund. Can we just talk briefly about thinking through what accounts to do this in? So I know that speaking for myself, because I mentioned a few times now that I've been doing weekly covered calls to generate income for the last couple months, I do that exclusively inside my IRA so that it's tax deferred. But if I were doing that in my brokerage account, I'd be paying taxes on all of those.
That would be at your marginal tax rate. Isn't that right, Jeff?
So I just maybe briefly, you don't have to go too deep into the weeds here, but like, how do you think about what kind of accounts to use for strategies? Does it matter what strategy it is and that kind of stuff?
It does matter. There are advantages and disadvantages, of course, to each. And many people I know do use covered calls in their IRA for the tax advantages of that, not to be taxed. If you use options in a traditional account, any option that you sell to open, so covered calls or selling to open puts for income, is taxed at the short-term rate, even if you sell it to expire more than a year from now. So that's a definite disadvantage. But the advantage is that's in an account where you can pull cash out anytime you want. So for me, that's largely what I'm doing, because I've done this as an income strategy for my life right now. So there are pluses and minuses to either account, and I wouldn't say one is better than the other. It's just a matter of where you're set up and where it makes sense to use options. Now, I will say IRA accounts generally, at least in the past, have more limitations on the types of strategies you can use.
The brokerages will be more limited in what they let you do, so you don't blow up your retirement money.
Yeah, and you can't. If you're selling put options in an IRA, you absolutely need all the cash on hand the whole time and so forth. So not to oversimplify, but writing covered calls in an IRA makes a lot of sense as long as it's a stock you don't mind losing and you're slowly building up more income, more cash in that fund for you, and to learn how to later have income that you can take out every year in retirement. And then in a traditional account, basically it's strategy first, worry about taxes second. Like, what's the best strategy for you and your objectives? taxes are a part of life and factor that in. It is why I do like SPX options, though. They're European style options. They're given preferential tax treatment, where if the option is open a year or longer, about 60% of it is taxed as long-term, even though you're shorting it, which is not the case with any short. You short a stock, it's a short-term tax rate no matter what. So look into SPX options to be more tax aware as well.
All right. That's a lot for just an introductory conversation about options. So Jeff, we're absolutely going to have you back on, likely multiple times in the quarters and years.
A 1 hour episode for every strategy there is.
Well, hopefully it gets better. I've been behind a regulatory wall for almost 6 years, so I've forgotten how to talk.
We'll help you fix that.
We'll help you.
Yeah, no doubt about it.
All we do is talk, so we can. You can help us understand options better. We can help you explain them better. Be a mutual relationship.
That sounds good.
So let me say this while I'm thinking about it. We'll put it in the show notes. You can find it in your podcast app, folks. You can find Jeff on Blue Sky and Twitter both. We'll have his handles for both of those in there. Any other social platforms that I think those are the main two, right?
That's it right now. Yep.
Perfect. We'll have that in there for you. Let's talk a little bit about what's next for Jeff Fischer going forward.
So very apropos to our conversation, I'm working on an options book. I'm just starting it. So it's nice to be recognized as, hey, you've taught options before. You have presumably a lot of knowledge still in your head. Let's get it out on paper. And so that'll be
this too, for full disclosure. Eventually, when said proposed book exists, we're definitely going to have you on to talk about it. But we did not have any PR person come out to us and say, hey, Jeff Fischer's working on. I DM'd Jeff and said, hey, you want to come on the podcast and talk about options? He said yes. And then he told us before we hit record that this was in the works. So go ahead.
That's right, Jason. And I love how unscripted this really all is. Especially because it was over the holidays and we all had family visiting. So we really couldn't communicate at all. We just set up the day and that was it. January 2nd in the morning, let's jump on.
We did forget to tell you the time. Yeah. And by we, I do mean Jason.
And by Jason, you should mean Jeff Fischer because Jason didn't do much here. So you're going to be working on a book about options. And from talking to other people that have come on that have written books, you don't just whip out a book in a couple weeks. What's the process going to be looking like here?
And this is new to me too, as a matter of fact. It only came about just before the holidays. I assume it'll take at least this year. The good news is the vision for it from the agent is just a few hundred pages. Just explain what options are, how they work, and your favorite, let's say, 4 strategies. And I think that's the perfect pitch because that's a great starting point. And then I said to him, well, what I had in mind in years prior was a book about both options and stocks and how you use them together. His thought was let's just do the options first. And then later, if that goes well, you can do a stock and option book. But anyway, this one I would assume will take all year to write. And that's if I'm disciplined. So we'll start that now.
You will be disciplined. I know enough about you to expect that you will be disciplined. Whether the writing agrees with your discipline is another thing that we'll check in with you periodically to find out about. But let's move beyond that. Let's talk about the real world. What are some things that motivate you in the real world? Now that you're not running a hedge fund, you're not running a service. Your obligations are to yourself and generating income for yourself to do things in the real world. What are those things?
So sustainability has always been my kind of watchword. And the other one, a favorite word would be abundance. If things are working naturally and well, they will naturally bring about abundance, at least in natural ecosystems. Like abundance was the rule. It's the rule of life. You need extremely abundant reproductive capabilities to keep any species going.
Zero-sum systems collapse.
Yes, exactly. And if something isn't at least holding steady, if it's only holding steady, it's under fire because calamities happen and diversity declines and so forth. So something needs to be growing. If it isn't growing, if it's declining, of course, it's headed just one direction. A slow decline should not make anybody comfortable. There's only one way for it to go. It's down to zero. To use a numerical example, there were 23 million elephants on the giant continent of Africa as of the 1800s, and now there are about 400,000. So and imagine a world without elephants. It's hard to imagine, but it could easily happen because woolly mammoths were here, and we're pretty certain we eradicated them with hunting, with pretty archaic hunting methods way back when. Now with, the methods we have, it's pretty easy to see us eradicate species. So sustainability has always been what my investing has been about. I've gone after companies that I thought could sustain value growth over many, many years. And so I was drawn to software companies foremost. It applies to the real world, the natural world as well. So one thing I'm doing is visiting apex ecosystems. I'm scheduled to go to Kenya and Tanzania in September this year as well. I'm hoping to go to Peru and Sumatra and a small corner of Costa Rica and study with conservation groups that are there, what's working there, what isn't, and try to see if there are similarities across these different ecosystems and regions of the world and similar solutions and so forth, all kind of in the name of what is sustainable, let alone what leads to abundance versus what leads to denigration and slow decline. I think it's one of the most important questions of our age is whether we can sustain healthy ecosystems. And it does tie into investing because a company is an ecosystem and it either sustains itself or it goes into decline. And you really need to spot those that are declining and stay away from them. So very eclectic future ahead.
That's fantastic. Definitely a lot of writing in your future is a culmination of both of these two endeavors that you're undertaking. All right, Jeff, I'm gonna pass the baton back to you one more time. Jeff Fischer, any last words on investing options or life in general you want to leave us with?
So just thank you to you guys. I enjoy the show, and I hope everyone has a great 2025 and invest with the long term in mind. It's likely to be a rocky year, and volatility can bring opportunity as long as you have optionality at your fingertips. So in my opinion, at least, don't always be 100% invested. Keep some cash, keep some optionality at hand, and then you can take a positive action when the market is throwing you some negative vibes. So let's have a great year, everybody.
Love that. Find the opportunity in the challenges. That's fantastic. Jeff, thank you for coming on. This was a great conversation, a lot of fun, and we definitely look forward to having you come back on sometime soon.
Oh, thank you.
All right, friends, as always, we like to remind you, we love giving our answers, these hard investing questions. Have the smartest of the smart people like Jeff Fischer to come on to give their answers. As always, you got to find your own answers out there, especially when it comes to things like investing with options. But I believe that you can do it. I really do. All right, everybody, have a great 2025. Jeff and other Jeff, we'll see you next time.
See you next time.